setting up as well to be a big week ahead for investors. We're going to get key inflation data on Wednesday. We'll get an ECB rate decision on Thursday. And it all comes ahead of the Fed's rate decision next week. Joining us is Jim O'Neill, former Goldman Sachs Asset Management Chairman and Chair of Northern Gritstone. Jim, always good to have you. Kind of laid out some of the things we're expecting, including a CPI report, I think, later this week as well. Do we stay here at 5% for some period of time? And would that be a good thing for the world economy?
I am increasingly leaning the way that we're going to have short rates staying higher for longer. And perhaps controversially, for those that think about it primarily from an equity market perspective or all markets, I'm not sure if that would be a bad thing either. You know, part of the bigger picture dilemma that I guess I've chatted with you guys about before recently is that we have this very, very long period of zero rates or close to it, and this incredibly accommodative monetary policy. And it's led to all sorts of consequences, as always, many of which we couldn't anticipate fully until they ended. From the days when I was still in my short trousers and beginning to think about economics, it was normal to have a significant positive level of so-called real interest rates. So ultimate, and probably therefore with it, a more effective allocation of credit and probably more consistent with whatever sustainable growth is being sustainable growth. So I actually think that'll be a good thing for the world if it turns out we could cope with it. But the dilemma, of course, is we're seeing a bit, and you discussed on the earlier segment, I think, for the equity markets, it's quite a challenge having to think about competing with rates at higher levels for a much longer period, particularly because until recently the market seemed surprisingly convinced that the Fed was going to be chopping again pretty soon. But it doesn't really seem to me that there's a lot of case for that, unless we see much, much weaker economic data.
Globally, we are seeing weaker economic data, Jim. We got the inflation numbers from China. I guess it's good that there wasn't a negative sign, but 0.1% CPI. European Commission revised GDP figures lower, including negative growth for Germany this year. We've seen the dollar strengthen a lot. Can the U.S. really pull off a soft landing if the rest of the world cannot?
I mean, ultimately, from the 40-odd years I've travelled through this kind of issue, probably not. So either the rest of the world is eventually going to start doing a bit better, or the opposite to what I just talked about will end up being the case in the US. You know, if you delve into components of what you raised there, the European situation is marginally intriguing in that it's Germany that's the weakest place of the ones that really matter. And that's a consequence of it being, of course, so immersed in getting its energy imports for far too long from Russia and the Eastern Europe. But at the same time, and it often seemed preposterous to me, really, frankly, for Europe's biggest country to be so dependent on its export performance to China. Germany's suffering from the same thing as China is, which is the China weakness. So in a way, I think it's partly the same question. But I'm saying it that way because one of these moons, Germany is going to stop being so dependent on just exporting somewhere else in the world and do something a bit more about having stronger domestic demand growth, which a country of 80 million people should be capable of.